Banks move trillions across borders every day. But what if a single digital token replaced the world's financial rails overnight? This is the high-stakes question behind what happens if XRP takes over the finance system. With transaction finality in under 5 seconds and fees less than a penny, XRP is already at the heart of secret pilot programs between banks and tech giants. If it really seizes control, fortunes, governments, and power could shift instantly. But who controls this new global money, and can the world's banks handle disruption at this scale? The answers challenge everything you know about trust, control, and who really owns money. At the heart of XRP's promise lies its ledger, a system engineered for speed, reliability, and minimal cost. Unlike blockchains that rely on energy-intensive mining, the XRP ledger uses a consensus protocol built around a network of independent validators. Each validator maintains a copy of the ledger and participates in confirming transactions. When a new transaction enters the system, validators compare notes, cross-checking proposed changes against a shared set of trusted peers known as the Unique Node List, or UNL. This process is not a race to solve cryptographic puzzles, but a rapid agreement among nodes. The result? Transactions are finalized in 3 to 5 seconds, regardless of global distance or volume. The UNL mechanism shapes trust. Validators on the list are chosen for their reliability and transparency, and the list itself is public. For a transaction to clear, at least 80% of UNL validators must reach consensus. This threshold is designed to prevent double spending and resist coordinated attacks, while keeping the network open to new, reputable participants. The protocol structure means that no single entity can unilaterally control the ledger, though the composition of the UNL does influence how decentralized the system remains. Transaction costs on the XRP ledger are measured in tiny fractions of a cent. The average fee is less than $0.01, set not by market bidding wars, but by protocol rules that adjust for network congestion. This fee is destroyed with each transaction, reducing supply over time and discouraging spam. In practice, this means that moving $10 or $10 million incurs virtually the same cost and settles with the same speed. Energy use is another defining feature. Because validators do not compete in proof-of-work calculations, the ledger's annual electricity consumption is a fraction of what legacy blockchains require. The system can process over 1,500 transactions per second, orders of magnitude above traditional payment rails, without the carbon footprint of mining-based networks. Finality is measured in seconds, not hours. Once a transaction appears in a validated ledger, it is irreversible. The combination of near-instant settlement, low fees, and high-throughput positions XRP as a technical outlier in global finance. These mechanics are what make XRP attractive to banks and payment providers looking to replace slow, expensive cross-border systems. But the same features that drive efficiency also raise new questions about trust, control, and systemic risk. Questions that will shape the debate as XRP's footprint expands. Banks and payment companies began searching for proof that XRP could deliver on its technical promise. In 2018, MoneyGram announced a pilot using XRP to power instant transfers between the United States and Mexico. The corridor was one of the first to test XRP as a true bridge asset, moving dollars to pesos in seconds instead of days. Transaction costs fell sharply, with fees measured in cents rather than dollars. MoneyGram's public filings noted a material reduction in working capital needs, as the company no longer had to pre-fund accounts in both countries. The pilot ran for over a year, processing millions of dollars in remittances before MoneyGram paused the program in 2020, citing regulatory uncertainty in the United States. Ripple also targeted remittance flows to Southeast Asia. In 2017, a partnership with CIMB in the Philippines opened a new corridor for US to Philippines transfers. The pilot demonstrated that XRP could move funds across borders in under 5 seconds, bypassing the legacy correspondent banking system. While transaction volumes were not publicly disclosed, the corridor's technical success drew attention from regional banks and payment providers eager to cut costs and settlement times. Across the Atlantic, Ripple worked with Santander to enable near-instant payments between Europe and the Americas. The early stages relied on Ripple's messaging technology, but by late 2018, select corridors began experimenting with XRP for on-demand liquidity. American Express joined as a partner, exploring blockchain-based settlement for business payments between the US and the UK. While these pilots often blurred the line between RippleNet and XRP usage, they all pointed to a common goal: eliminating friction from cross-border payments. Enterprise adoption extended beyond remittances. In 2021, Ripple acquired Medico, a Swiss digital asset custody firm. The move signaled a push to integrate XRP settlement with institutional treasury management, offering banks and corporates a secure way to hold and transfer digital assets. Partnerships with software providers like Kyriba further embedded XRP into corporate payment workflows, promising real-time liquidity and streamlined reconciliation. By 2022, Ripple's network spanned over 300 financial institutions, with pilots and early production corridors in North America, Europe, and Asia. The momentum from these market tests provided the first tangible evidence that XRP could operate at scale in regulated environments. But for every successful pilot, questions lingered about transparency, adoption rates, and regulatory headwinds, issues that would soon come to define the next phase of XRP's evolution. Ripple's control over XRP's supply is anchored by a massive on-ledger escrow. In December 2017, Ripple locked 55 billion XRP, over half of the total supply, into a series of cryptographic escrows programmed to release 1 billion tokens each month. This schedule was designed to calm market fears of sudden, destabilizing sell-offs. Each month, any unused XRP is returned to escrow, extending the release timeline and keeping a steady, predictable flow. But the mechanics of this system have drawn scrutiny from academics and market analysts alike. A blockchain governance researcher at Cambridge describes the escrow as a double-edged sword. On one hand, it provides transparency. Anyone can audit the release schedule and track how much XRP Ripple holds at any moment. On the other, it concentrates an extraordinary degree of influence in the hands of a single corporate entity. Even with public commitments to responsible sales, Ripple's ability to inject or withhold large amounts of XRP from the market presents a structural risk. A coordinated release or a sudden halt could trigger price swings, liquidity shocks, or even systemic instability in corridors dependent on XRP settlement. Validator composition further complicates the picture. The XRP ledger's unique node list, or UNL, is the backbone of consensus. As of late 2025, the default UNL includes just 35 validators, while over 190 are technically active. Ripple has steadily reduced its own validator count, committing to retire one for every 2 added by independent parties. But the default list remains tightly curated. The Nakamoto coefficient, a measure of how many validators must collude to compromise the network, sits at a low 41 out of 100. This is far below the scores posted by Ethereum or Bitcoin, leaving the system more vulnerable to coordinated action. The XRPL Foundation, incorporated in France in 2024, now oversees governance reforms. Plans include a rotating board, expanded community representation, and incentives for validator diversity. Yet, protocol changes and emergency interventions are still likely to involve closed-door coordination among Ripple, the XRPL Foundation, and major validators. The decision map for upgrades, especially in crisis, is not fully transparent. Escrow and validator concentration together create a paradox. XRP's technical model promises open, borderless settlement, but its governance structure concentrates power in a handful of actors. The decentralization coefficient remains low, and the risk of collusion or unilateral action persists. As XRP's role in global finance grows, these control vectors become not just technical footnotes, but potential flashpoints for market instability. Bank treasurers and families around the world share a familiar frustration: money stuck in limbo. For banks, this means billions locked away in nostro accounts, foreign currency reserves held abroad to settle international payments. The numbers are hard to ignore. The Bank for International Settlements puts the global total at over $27 trillion, funds that sit idle, earning little, and exposed to currency swings. A Treasury CTO at a regional bank lays it out plainly. Every market requires its own pre-funded pool, often in volatile currencies. Managing these accounts is tedious and costly. We tie up capital that could be used for loans or investments, he says. If we could move money instantly, nostro balances could drop by half or more. The appeal of XRP rails is simple. Eliminate the need for pre-funded accounts. Instead of parking dollars or euros overseas, a bank can convert local currency to XRP, send it across the ledger, and settle in seconds. No pre-funding, no lengthy reconciliation, no capital stranded abroad. Analysts estimate that if even 30% of global nostro balances were released through instant settlement, more than $8 trillion could be put to work elsewhere. In the US alone, freeing up $1.5 trillion could boost lending and investment, while annual savings on transaction costs might reach $7.5 billion. For families, the stakes are personal. Migrant workers sending money home to the Philippines or Mexico lose 5 to 8% of each transfer to fees. On a $200 remittance, that's $10 to $16 gone before the money arrives. With XRP-based remittance providers, fees can fall below 1%, and funds arrive almost instantly. For a family depending on monthly transfers, the savings are significant: money for food, tuition, or medicine. In the Philippines, where remittances exceed $36 billion a year, the World Bank estimates that reducing fees below 1% would keep an extra $1.8 billion in recipients' hands annually. A remitter in Manila describes the change. Her phone buzzes, and within seconds, her mother receives the funds. Before, we waited days and lost so much to fees. Now, it's almost instant. The money goes further. For banks, it's about unlocking dormant capital. For households, it's about stretching every dollar. These incentives, measured in trillions for institutions and daily needs for families, are hard to ignore. Central banks did not wait for XRP to dominate the rails before responding. As XRP-based corridors gained traction, policy teams inside the Bank for International Settlements and major central banks began designing digital currencies to compete directly. The Bank of Thailand and Hong Kong Monetary Authority launched Project Inthanon Lion Rock, a cross-border corridor that deliberately walled off domestic settlement networks from foreign access. In this system, banks could only transfer value through depository receipts, tokens issued and redeemed by a joint operator node under central bank control. Non-resident banks were barred from holding domestic digital currency. Every transfer required approval from both sides of the corridor, with liquidity providers and queuing mechanisms engineered to prevent any single asset, like XRP, from acting as a universal bridge. A central bank payments director explains the calculus. Our job is to guarantee settlement finality and monetary sovereignty. We cannot outsource that to a private network, no matter how efficient. The architecture of these CBDC corridors reflects a political choice as much as a technical one. Atomic settlement models, where two central banks synchronize transfers without intermediaries or bridge assets, remove the need for XRP entirely. Each side retains control over issuance, access, and protocol rules. If one leg of a transfer fails, the whole transaction unwinds, preserving the integrity of both monetary systems. Legal teams moved in parallel. In August 2025, a U.S. federal court classified XRP as a digital commodity, clearing some regulatory fog, but leaving banks in limbo over how much XRP they could hold as inventory. Compliance officers at major institutions flagged the risk. Holding significant XRP on balance sheet could trigger new capital requirements or even outright bans, depending on future guidance. Legal counsel for a European bank points to the corridor design. We can use XRP as a bridge only if regulators allow it, and only through licensed gateways. Every off-ramp is a potential choke point. Sanctions experts raised another red flag. The transparency of the XRP ledger, every transaction visible, every balance auditable, offers one kind of compliance tool. But off-ledger conversion remains the weak link. If sanctioned actors can find an unregulated gateway, they can bypass restrictions. U.S. Treasury officials monitor these flows, ready to blacklist wallets or exchanges that fail to enforce KYC and AML rules. The threat of secondary sanctions, cutting off entire institutions from dollar clearing, keeps most major players in line. The policy chessboard is crowded. CBDC networks designed for sovereignty, legal rulings that define the perimeter of XRP's use, and a sanctions regime that turns every gateway into a front line of enforcement. The containment strategy is clear. Compete with CBDCs where possible, regulate XRP gateways tightly, and use legal levers to preserve control over cross-border flows. The contest between open rails and sovereign networks is now a matter of legal code, protocol design, and global compliance. A future built around XRP could take many forms. In the most optimistic scenario, the world's major economies agree on a common licensing standard for gateway operators. Every institution wishing to issue or redeem assets on the XRP ledger must obtain a regulated financial license in its home country and pass rigorous anti-money laundering checks. Compliance officers, faced with a new landscape, spend months drafting protocols to satisfy both domestic regulators and the cross-border demands of the ledger. The result? A tightly controlled system where settlement is instant, costs are minimal, and every transfer is traceable. Market volatility drops as gateways are required to maintain deep reserves and submit to real-time audits. In this world, XRP's rails become the backbone for global payments, and systemic risk is managed through enforced transparency and circuit breakers embedded in protocol. A more fragmented path unfolds if licensing standards diverge. Some jurisdictions embrace strict gateway oversight, while others allow loosely regulated or even unlicensed entities to operate. Payment corridors splinter as banks and fintechs navigate a patchwork of compliance requirements. The ledger's speed and efficiency remain, but trust fractures. A compliance officer at a major European bank describes the new reality. Every transfer is a negotiation. We double-check every counterparty, and the risk of a rogue gateway never goes away. Volatility spikes in corridors where regulation is weak, and market participants begin to price in the risk of sudden freezes or asset lockups. The promise of frictionless payments is tempered by the complexity of cross-jurisdictional oversight. The worst-case scenario begins with a single point of failure. A top 5 gateway faces a liquidity crisis, perhaps triggered by a cyber attack, a regulatory freeze, or a wave of mass redemptions. News spreads in seconds. Holders rush to redeem their IOUs for fiat, draining reserves and sparking a digital bank run. Automated market makers widen spreads, liquidity dries up, and the price of XRP whipsaws as panic ripples across corridors. Compliance teams scramble to assess exposure, but the speed of settlement leaves little room for intervention. Within hours, payment flows seize up in affected regions, and confidence in the system erodes. Regulators worldwide call for an emergency review of gateway licensing and reserve requirements, but the damage is done. The experiment in open, borderless settlement faces its first real systemic test. The new financial order built on XRP rails would redraw the map of winners and losers. Payment processors that integrate XRP rails stand to capture new markets, shaving costs, and accelerating settlement. Remittance-dependent economies, where every percentage point in fees means millions in household income, see a direct boost. Banks that adapt early, freeing capital from Nostro accounts and offering instant foreign exchange, gain a competitive edge. Frontier markets with limited correspondent banking ties could leapfrog into global liquidity, bypassing the slow lanes of legacy finance. On the losing side, correspondent banks face shrinking revenue as cross-border fees evaporate. Foreign exchange market makers see reduced spreads and volumes. National monetary authorities, especially in smaller economies, risk losing control over capital flows as offshore XRP rails bypass traditional levers. For every institution that unlocks dormant capital, another loses a source of stable, fee-based income. Policy tools become the new battleground. Central banks and regulators deploy three main levers: licensing standards for gateway operators, reserve requirements for on-ledger and off-ledger intermediaries, and interoperability protocols to manage flows between sovereign central bank digital currencies and open networks. Multilateral bodies like the International Monetary Fund and the Bank for International Settlements push for global standards, aiming to ensure that every gateway, regardless of jurisdiction, meets minimum compliance and reserve benchmarks. The concept of a reserve backstop gains traction. A shared liquidity pool or insurance fund designed to absorb shocks if a major gateway falters. A central banker sums up the new reality. We cannot stop technological change, but we can shape its guardrails. The challenge is to align efficiency with resilience, so that a faster system does not become a more fragile one. In this landscape, the balance of power depends not just on who moves money fastest, but on who sets the rules for trust, transparency, and intervention when the unexpected arrives. In 2022, the global Nostro account balance was estimated at $27 trillion, capital locked by current cross-border systems. XRP pilots in corridors from Japan to the Philippines have demonstrated sub-5-second settlement and near-zero fees, saving remittance users over $1.8 billion in documented cases. Yet, as central banks develop digital currencies and regulators debate legal classifications, core questions remain. How will governance and compliance adapt if a single protocol gains dominance? Documents reviewed confirm that monthly escrow releases and validator concentration present structural risks, while expert testimony highlights unresolved tensions around sanctions enforcement and financial sovereignty. Today, XRP's technical proof and enterprise adoption are clear, but the full implications of a global shift remain untested. As financial infrastructure evolves, the record shows that speed and efficiency alone do not resolve deeper issues of control, oversight, and equity.